Hello, everyone. It is Friday, October 14th. Today on the Final Bar, we will wrap this week. Thursday's renewed optimism leads way to Friday's renewed pessimism. We'll talk about the give back on all the major equity assets and the NASDAQ in particular. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of StockCharts. StockCharts is built on three pillars: tools, education, and commentary. I hope in our show we're able to highlight some of the tools you can use to better understand these markets, particularly in volatile, uncertain times. Hopefully you feel the educational component where we try to highlight how we're using these tools and give you some best practices in technical analysis and commentary. I hope our observations, looking at the flickering ticks of the daily movements and connecting those to the longer term trends, hope all of that is of value to you. And I hope you enjoy the daily recaps we provide on the Final Bar. Great guests on the show. Had a couple of really fun conversations, particularly with Katie Stockton yesterday. It was a lot of fun. So if you missed that, make sure you go back to our episodes on YouTube or on StockCharts TV on demand. For the remainder of this week, starting next week, three good guests for you. On Tuesday, the 18th, Dana Lyons. He's the founder of J. Lyons Fund Management and the editor of the Lyons Share Report. Wednesday, the 19th, Hema Reddy, author and expert in GAN analysis. And then on Thursday, the 20th, Jeff Hughes from JWH Investments. A really good take, as always, from Jeff, looking at individual stock ideas. Let us also, I wanted to let you know about a webcast we have coming up with Market Misbehavior coming up next Tuesday, the 18th at 1 o'clock Eastern. I'll be doing a special presentation called the Market Bottom Checklist Revisited. Back in June, I did a webcast talking about my 10-step market bottom checklist, things to look for when the markets are in distribution mode, which I would argue they're very much still in. I'll update that checklist reflecting on the current market environment. We'll look at the current charts and how they relate to those 10 steps. And also we'll talk about how that relates to the seasonal trends, which tend to occur October into November and December. To sign up for that free event, go to marketmisbehavior.com/October and check it out. Let's continue on our show today by wrapping the week. I did want to start with a poll. We always have a poll running on our live stream page at stockcharts.com and also on our social media accounts. So give us a follow on Twitter. Check us out on Facebook, LinkedIn, anywhere where you're at. And also, of course, our YouTube channel. We asked you recently, how important are seasonal cycles in your analytical process? Very important, somewhat important, not very important, or what's a seasonal cycle? So I'm thrilled that only 2% of you had no idea what I was talking about with seasonality. It's a key part of the market analytical process, I would argue, particularly in certain parts of the year. September, October, November, December is important because we're transitioning from the seasonally weakest part of the year in October to the seasonally strongest part of the year, going into the really when you get into the bulk of the fourth quarter. So if it is not something you've thought about, this is a really good time to think about it. Larry Williams just put out a Market Outlook show on Monday, which you can find at stockchartstv.com or on our YouTube channel, where he talks about some of those seasonal tendencies. So make sure you check that out if you're not familiar. Let us wrap the week. When we wrap the week, we do a couple things. First, we'll just check in on what happened today. Big reversal day after yesterday's strength, followed by today's weakness, putting the S&P back below 3,600. We'll also look at our wrap the week chart, looking at the 5-day returns in some of the major asset classes. We'll finish off looking at the Mindful Investor Live chart list. We have a lot to cover. So let's start with the major asset classes first. S&P down over 2% today. This is after yesterday ripping to the upside, nearing 3,700. Now to the open today, the S&P just briefly teased that 3,700 level and then never looked back. The remainder of the day really in distribution mode. All the gains we saw yesterday, much of those, I'll give about half of the gains, maybe 2/3 of the gains we had just on yesterday's trading alone, A lot of individual stocks like Tesla, which if we have time, we'll talk about, actually gave back all of yesterday's gains and more, actually closed at a below yesterday's open. So quite a reversal day, quite a change of character just from Thursday to Friday. And when you look at what happened during the course of the week, you see, I would argue overall still very much in distribution mode. The NASDAQ, by the way, down over 3% today. So the S&P is below 3,600, the NASDAQ around 10,320. That's the NASDAQ composite. The VIX remaining fairly elevated above 30. We're just above 32 today. Other asset classes, very quickly, you had yields going higher. The 10-year yield closing the day above 4%, which is significant. That is may have been the first time that that has happened. And we'll look at that in quite some time, of course. We'll look at the chart here a little later. Bond prices obviously coming down, the dollar index moving higher. So if you're wondering why the equity markets were so weak today, from a technical kind of intermarket analysis perspective, I would say strong dollar, higher interest rates, all related to inflation. That is what's causing the equities to finish the week limping into the weekend, I would say. All the commodity ETFs that we track, the top 8 that we highlight on our market dashboard, all in the red today. Gold down 1.25%, silver down over 3%. Energy prices as a whole down fairly significantly. Energy sector was one of the worst today. Cryptocurrencies chopping around quite a bit this week. Bitcoin being repelled, nearing the 20,000 level in the last 24 hours, but rotating back downwards, now nearing the 19,000 level. And Ether really back down to 1,300 after breaking above it over the last 24 hours. Just to finish off our recap today, healthcare, the best performing sector, but all 11 S&P sectors in the red today. Healthcare, the best of the bunch, still down 0.75%. Everything else was down quite a bit. Utilities, 1.4%, financials, 1.7%, as well as communication services on the bottom. These are the sectors that really drag things lower. Consumer discretionary, energy, materials, technology, all down over 2.5%, along with REITs. So a tough day. And again, it's funny to me how quickly I see renewed optimism. Yesterday, I'm getting people writing me, calling out, because I'm still, of course, publishing things in articles and on social media talking about the bearish phase we're in. I'm getting a lot of pushback from people saying it's, rally mode, bottoms in. And I don't know, that you may end up being right. That may be true, but it's hard for me to be optimistic on one day's trading. And for me, it's all about follow through. If you were looking for a follow through day, today you certainly didn't get that, right? We didn't get that renewed optimism, that sign that yesterday was the beginning of something. Today was more of we're back to that bearish environment we've been in for quite some time. And again, bottoming is a process. It takes time. And I arguably would say we're not quite done with that yet. Let's look at our wrap the week chart. So this is a chart I like to reflect on every Friday, and it's a simple chart. It just looks at the 5-day returns in some of the major ETFs and major asset classes that we talk about. And it's good to just take a step back. It's so easy to get caught up in the day-to-day movements and draw a lot of conclusions based on one day's move. And I think a lot of people fell victim to that, most likely yesterday, right? Thursday was such a nice, strong day to the upside. Today, the sell-off pushed many things down to a new low for the week. And let's talk about how things played out. Only one thing was actually finishing the week in the positive. And the bad news, it's the dollar, right? One of the bearish looks, or one of the looks we've seen in 2022 that has been just a hallmark of 2022, the bearish year, has been weeks like this, where it's a strong dollar. Dollar's up and everything else is down. That's why we've called the dollar the wrecking ball for risk assets. I think today and this week, we've seen more of that, right? So if you ignore Thursday's sort of mean reversion, the end of the week, it's strong dollar and weaker everything else. From the top, here's how everything else came out through the end of this Friday session. Here we have small caps, the IWM, which is the Russell 2000 ETF, down 1%. In black, we have the S&P 500 down 1.4%. Here's Bitcoin, actually not a bad week, not a horrible week, but not great, down 1.8%. In red, bond prices, this is the TLT, down 2.4%. Gold and the NASDAQ 100, similar week, down 3.1 for both of those, almost to the same level. In orange, we have emerging markets down over 4%. And the worst performer of the bunch, crude oil. This is using the USO as a proxy for crude oil prices. That's a bullish oil ETF, which is down 6.6%. Let us finish off our weekly wrap segment by looking at the Mindful Investor live chart list. As a reminder, this is a list of charts that I keep updated on the StockCharts platform. You can access it from my blog on StockCharts.com. The way you get to that is go to the articles tab, go to my page, which is called The Mindful Investor, and you will see the link to this list of charts at the top. It's a little gray button at the top of my blog. Starting out with our market trend model, no change this week, and that's been the case for the last month. Starting in early September, all three of my time frame market trend models have been negative. So my model looks at long-term, medium-term, short-term, and that's loosely defined as a couple days, a couple months, couple years is kind of how I would generally describe that. Although that is a loose, again, that is not a hard and fast rule. That's a general summary of these timeframes. All three of these have been negative since early September, coming off of that peak in August when the short-term and medium-term models were both bullish. Now, all of them pretty consistently bearish from early September on. So again, the way I think of a market when my market trend model is completely bearish is just to think risk off, to focus more on being defensive, to focus much more on capital preservation than capital gain. So instead of looking for shooting the lights out with another buy idea, I'm much more focused on updating risk levels, making sure you lock in whatever gains you may have on charts that have been working. As always, I don't think it's a bad thing to have a small portion of your portfolio that's sort of that opportunistic in any environment. There's probably a good chart out there kind of thing, like United Healthcare comes to mind, or one of those biotech names that's actually working pretty well, some energy names. I think it's totally fair to be in those names if you're able to do so. But again, that should be a smaller portion, in my opinion. That should be a smaller portion of it. The bulk of my portfolio is fairly defensive here, and that's what my market trend model being completely bearish tells me to do. And that's kept me out of the really painful parts of market history, and I'm pretty much okay with that. The daily chart of the S&P looks like this. And again, yesterday's bar was weird. I was talking with Jayanthi, who's our newest addition to the StockCharts team. She is our content manager, just ramping up, just joined us a couple of weeks ago. She was a longtime editor of Stocks and Commodities magazine. If you've ever read that, we're really excited to have her join the team. She's still ramping up. And over time, we're going to ask her to take on more and more of the content. We will still have a great suite of contributors, of course, and my own contributions and others will still be coming. We have a lot of great expertise to share with you. But Jayanthi, as a great, as an editor and as a content producer, I think can really enhance and add to the great content that we've provided from our great group of contributors. But anyways, I was chatting with her yesterday just about how strange the day was, right? My conversation with Katie Stockton on this show yesterday was focused on what an unusual day it was, right? With a big gap down at the open and just rallying so significantly. Look at the volatility, look at the range on yesterday's trading for the S&P versus any other day. Can you find another day that it's that wide? And I can't. Maybe this bottoming period from late February is the only other day that stands out, that jumps out as being so significantly positive coming off of the lows. But today, giving a lot of that back. This is actually called a dark, I had to think for a second there, a dark cloud cover. We have a big up candle, a big down candle. It gets at least 50% of the way through the real body. That's a negative sign. I wanted to update this one. I was asked in an interview yesterday, what was the reason for the bounce off of 3,500? I was interviewed by Reuters earlier today. One of the things we talked about was that bounce off that 3,500 level. That's a key one, right? That's an important one because it's a 50% retracement from March 2020's low to January 2022's high for the S&P 500. Not surprised to have a bounce off of that level. I would be equally not surprised to see a break of that level and we move further down to 3,200. Breadth conditions overall remain very negative. And I just wanted to quickly get to this chart here, which is the relative strength of consumer discretionary to consumer staples. This one right here, all right? One of the great signs, I think, looking into July, August, September, was even though the S&P was breaking out above its June high and testing its August swing high, look how the equal weighted consumer discretionary versus consumer staples ratio never broke above that level. That has been a great indicator, in my opinion, that any uptrends here are to be questioned. So instead of buying the dips, we should be selling the rips. And so far, you can see this is testing a new multi-month low. This breaks below the June low in either case. I think that confirms a much higher likelihood of further downside. We need to take a quick commercial break. Back, powering up your use of the StockCharts platform. We'll see you in a minute. Hey guys, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close for our show. A couple quick announcements before we continue on. First off, we welcome your feedback and particularly welcome your questions. We're going to do a mailbag segment here in a minute, and we'd love to feature one of your questions live on the air in our next mailbag on Tuesday's show of next week. You can get your questions to us via email, thefinalbar@stockcharts.com. We are on Twitter at FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. Hope to answer one of your questions live on the air next week. Also, go to StockChartsTV.com. That is our on-demand platform. So much great content every trading day. I mentioned Larry Williams' special that I think dropped on Monday or Tuesday of this week called Up, Up, and Away. I would very much encourage you to check that one out. It talks a lot about seasonality and the strength most likely that we see through year end. Also, some great guest interviews we had on this show with Katie Stockton and many other of my great guests, Bob Lang and others this week. Go to StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. Our next segment is called Power Up. This is where we upgrade your use of technical analysis and the StockCharts platform. I was talking with Grayson Rose a couple hours ago as we were going through, we have a weekly call to sort of talk about the markets, but also talk about some development goals with stock charts and compare notes, make sure we're focusing the product where we want it to be. And we're looking weeks, months, even years down the road as we talk about how to upgrade the product. I actually have his chart up. This was his contribution, one of his contributions to the market survival kit that went out to ChartCon members, StockCharts members that attended ChartCon have access to a really cool list of charts from some of our contributors. But one of the things we were talking about, Grayson and I, was the performance table. We have a great performance table within StockCharts ACP, also within the StockCharts regular website platform, which you can access if you bring up a chart list. One of the views you can do inside the regular StockCharts platform is called performance. You can also do it within StockCharts ACP. So just bring up the table. It's probably down here at the bottom. You may not even realize it's there. Hit the little up arrow. That'll expand this table, shrink your chart up a little bit. The idea is you can look at a list of stocks and then click on the tickers to update the chart. Pretty cool. But if you look at the performance tab, you can see you can look at any list of stocks. So here I'm looking at the technology names. You can sort them based on performance over different time frames. So if I sort this sector, this list of stocks by year-to-date performance, I can see only 3 of the stocks within this group actually are in the green year-to-date. You can also, and this is really cool, type in a relative number. So if I put in a ticker here, it's going to show the relative strength of all the stocks in my list or ETFs in my list relative to whatever denominator I put in. So I can see on a relative basis what have the returns been on any of these different timeframes. The performance view in ACP and also on StockCharts.com is a brilliant way of making sense of a list of securities and seeing what has performed well and what has struggled over whatever time frame you want. That is our segment, Power Up, upgrading your use of the StockCharts platform. Let's continue on today's show with the StockCharts, the Final Bar mailbag. Our mailbag's always open. The Final Bar at StockCharts.com is the way to get your questions to us. And here's question number 1. Dave, what are your thoughts on PSQ and SH for riding the shorts? I mean, I know they reset every day, but I don't see that as a problem. Do you? Really good question. And thanks so much for sending that in. If you guys aren't familiar, SH is this. That's the ProShares Short S&P 500. PSQ is this one, which is the ProShares Short QQQ. So these are not leveraged ETFs. You're not getting a multiple of an inverse weighting, but you are basically getting the inverse. So if the idea is if the SPY is up 3% on a particular day, the SH should be down 3% on that same day. So do I have a problem with that? I don't. I don't have a problem with using inverse ETFs for sure, and even the leveraged ETFs, as long as you understand the structural risks that are embedded in those things. And you alluded to that in your question. You said, talk about the reset every day, and I think that is a very real issue. What happens is, depending on how just the day-to-day dynamics over time, the returns in a leveraged ETF and particularly an inverse ETF can become a little bit disconnected with the longer-term returns in the underlying security, right? So if the S&P is up 10% over a 6-month period, there's no guarantee, there's no structural thing built into the SH that it will be down 10% over that same period. It might net out to be the same, but it might not, right? And you will find that because it is tied to the daily returns. And that's what that vehicle was designed to do. They were really designed for short-term traders to get exposure of a certain type over a short-term time frame. What I found is a lot of investors and even advisors are holding these for longer periods of time. What you just need to know is that it is not guaranteeing you an inverse exposure over a longer period of time, right? It's a day-to-day inverse exposure. So if the day-to-day returns have a certain noise to them, it could be very different than you might expect. As long as you understand that and understand what that means, the potential impact, I think it's totally fine. If you bought the PSQ, on January 1st of this year, had a pretty decent year so far. You're up about 50%, while a lot of things are down quite a bit, right? And struggling to make up previous gains. So I get the appeal of these. I have certainly used them on a limited basis in my own portfolio. At this point, I don't really own anything like this. I'm happy just being out, sitting on my hands and waiting for an opportunity to present itself. Thanks so much for that question, by the way. Next question. Does the yield curve being inverted indicate that we will not have a rally, as Larry Williams mentioned in his recent presentation? Now, I don't remember exactly what presentation you were talking about. This actually came in about a week ago, so I think it might have been his previous market outlook, which you can find at stockchartstv.com. I'm not sure which one you're talking about, but I will address the question. And the question is, how are these things related? So the inversion of the yield curve is certainly important, and I have a really good chart of this. I'm going to spend about 20 seconds to see if I can find it. I would probably, knowing how my brain works, I would probably put it here. This is a list of really cool historical charts where I'm tracking it, and it's going to be like bonds and recessionary periods. Here we go. Yield curve 2s and 10s. I knew I had it here somewhere. So basically what I did here was just wanted to show the relationship between yield curve inversions and recessionary periods. Now, this is not looking at the current situation. It's looking backwards, but basically you can see here when this is looking at the spread between the 10s and 2s, right? So 10-year yields minus 2-year yields, the shape of the yield curve. This line is going up. The yield curve is steepening. If this line is going down, the yield curve is flattening. You can see the zero line. It might be better if I put a little horizontal line here, which I will. But if I do this, you can see the zero level and just look at all those times when the black line, the spread has gone below zero. That's an inverted yield curve. Going back the last 20 years, every time we've had an inverted yield curve, a recession has happened soon after. So what that means is an inverted yield curve tends to be a pretty good predictor of a recessionary period. The yield curve currently is inverted. And it's becoming more so, right? If you look at the spread between 2s and 10s, it's about 50 basis points, one of the lowest levels we've seen in many, many decades. I think that tells us we are very much in a recessionary period. I think that is happening going forward here for a little while. What does that mean for you as an investor? Stocks don't tend to do very well going into recessions, of course. They tend to improve. And if you're looking for when the recession is over, you look at the stock market. Stock market is one of the best leading indicators for the economy. You can't look at economic conditions like recessions and use that to predict stock prices. That's actually getting it reversed. So look at the equity markets as a sign that this is getting better. So an inverted yield curve tells you conditions are getting pretty bad. That's where we're at now. Where do you look to find indications that things are getting better? So two things I would look at. Number one, bond prices, because when bond prices rally, that means interest rates are coming down. Most likely means the conditions are starting to improve and things are starting to get better a little bit. Then look for an improvement in the equity markets. That is the best indicator that the economic conditions are going to start to improve. That's where I would look. Next question. Thanks for that question, by the way. PG, Procter & Gamble, hasn't had 4 consecutive down quarters since StockCharts' first data point in 1968. It is, however, currently working on 4 down quarters. In your humble opinion, should we be buyers? Really interesting question. I tell you what, I have not created a good quarterly chart. I don't even think I have a good model for that. But I will take my monthly chart and kind of manipulate it from there. So we say period, quarterly, it's down here, and we'll say like 50 years. I don't look at this chart very often. So your comment was, we have had 4 straight down quarters. And again, the current quarter isn't done yet. So let's, number one, I would say pause there. If you're looking at this current chart, this is the current quarter, which is not quite done yet. So you can't really draw a conclusion on this chart until the quarter is done. And that's a common issue you see Oh, if you're looking at a weekly chart or a monthly chart and you start to draw conclusions when the current bar isn't completed yet, you have to remember this is an active bar or an active candle. We could rip to the upside over the next 6 weeks, and all of a sudden that does not look anywhere near what you're thinking in your question. So I would say the fourth quarter that we're in right now is not quite done yet. So let's wait to pass judgment until that has been the case. Having said that, would I be a buyer because there have been 4 down quarters? No, I wouldn't. And I would say, I mean, you have to look back at previous secular bear markets. If you look back in like 2000 to 2009, you really didn't see 4 down quarters at all here. Actually, the first time you've seen it since I'm seeing it actually back here. You mentioned not since 1968. I'm seeing this here looks like 4 down quarters. It actually looks like 5 down quarters. But again, that's kind of my reading on it. That alone would not be a reason to buy. Looking at trend, again, quarterly charts are not something I look at a ton. The monthly chart, absolutely. And looking for a downtrend in the monthly and that reverting to the upside, absolutely. I think it would be a valid thing. So would I be a buyer because we've had 4 down quarters? No, that tells me that this is different than this is a pretty painful bear market phase for a company like Procter & Gamble. Would that alone tell me to buy? Absolutely not. Does this tell me to be focused very much on things like the PPO, probably the monthly and weekly PPOs, looking at the just the trends and seeing if you get a reversion to the upside? Absolutely. And the good news about things going down, as you can see from this long-term chart of Procter & Gamble, in the end, this chart has pretty much all the time resolved to the upside. If your runway is long enough, even in a cyclical bear market, which I would argue we are very much in the middle of, the long-term trend remains positive. And the deeper we get in price now just means you get an opportunity to buy in to great companies and ideally ride them to the next cyclical bull market, which has arguably not happened today, but hopefully will come very soon. We have to wrap the show. Those were awesome questions. Thank you guys so much. As always, we need to go right to the 3 and 3 charts in 3 minutes to tell the story of this market. Here is chart number 1. $TNX is the 10-year yield. I love that question about the yield curve inversion. As a reminder, we have a dynamic yield curve function. You can find that in the charts and tools segment of our website. Brilliantly simple, but brilliantly powerful. Tells the story of the relationship between interest rates and equities. Inverted yield curves tend to indicate a recessionary period. It's actually been a pretty good predictor of economic weakness. The condition we find ourselves in now, particularly with the inflation data that we had updated this week, inflation still very much an issue. It is not dissipating as some have suggested it might. As a result, interest rates are going higher, bond markets are going lower, equity markets are going lower, value stocks are outperforming growth. And if you're thinking about what's leading going forward, as much as we want technology and consumer to lead the way out of an environment like this, as long as rates stay high, I think it's value stocks where you look for opportunities. Places like energy, industrials, those are the places I would most likely see opportunities. The yield curve is continuing to invert and continue to flatten more and more. Chart number 2, the chart of Tesla. We highlighted candle charts yesterday because you had a lot of bullish engulfing patterns. It wasn't the case here for Tesla yesterday, which would be a big down day, followed by a big up day where day 2 engulfs day 1. Now we have the complete opposite. We actually have a bearish engulfing pattern 1 day later. When you see a big move higher like you saw on Tesla yesterday, our comment was look for confirmation. See if you get follow through to the upside. We very much did not get that. Not only did we not get follow through, Tesla made a new low for the year today, right? So after Thursday's rip to the upside, Friday gave all of that back and more. That tells me all I need to hear to confirm a bearish market phase and remain fairly defensive, which is where I am at in my own positioning and mentally as well. Finally, let's finish off the week on a bright note. This is a challenging week among many challenging weeks. Let's remember that there are always stocks with constructive patterns. You just have to know where to look. Amgen, very close to making a new 52-week high, having a pretty decent week with a gap higher on Tuesday, following through. Remember, there are names out there with strong relative performance. Make sure you're screening for those ideas. That's it for this week. I'm Dave Keller here with StockCharts.com. Have a fantastic weekend. We will see you all next week on StockCharts TV.